Welcome back as we move on to study the equity aspect of the cost of capital. Before that, let's define the equity risk premium and the approaches to estimating it. We'll start with a definition and learn how to estimate it using historical data. We'll also learn how to make forward-looking estimates of the equity risk premium. Let's dive right in. For a risk-averse investor, the required return of a stock has to be higher than that of the risk-free rate in order to convince the investor to invest. If we aggregate all the risk-averse investors and all the stocks in the market, this aggregate return over the risk-free rate is known as the equity risk premium. If we rearrange the terms, it's the difference between the required return on equities and a specified risk-free rate of return. Strictly speaking, equity risk premium should depend on investors' expectations for the future. However, sometimes you may find the term used to refer to excess return of stock over a given past period. This translates to the two broad approaches to estimate the equity risk premium. One is based on historical data, and the other is based on current expectational data. An historical estimate of the equity risk premium consists of the difference between the historical mean return for a broad-based equity market index and appropriate government bond yield over a given time period. Its strength is its objectivity and simplicity. Also, if investors are rational, then historical estimates will be unbiased. As an analyst, there are four major considerations when taking this approach. Firstly, you should select an equity index that accurately represents the average returns earned by equity investors in the market being examined. For example, if the intent is to estimate the equity risk premium for a US equity investor, a broad-based market value-weighted index like the S&P 500 should be selected. The next step is to select a proxy for the risk-free rate. The choice is usually between short-term government debt like T-bills to estimate a risk premium for short-term investments and long-term government bonds like T-bonds to estimate a risk premium for longer-term investments. If the government bond yield curve is upward sloping, the risk-free rate is higher for longer-term bonds, so the estimated risk premium for long-term investors will be smaller. And for short-term investors, the risk-free rate is lower, so the equity risk premium for short-term investors is higher. Third, the time period for computing the estimate. This is a particularly important consideration because the choice of the time period can have significant impact on the estimate. In using historical data to estimate equity risk premium, the implicit assumption is that the mean and variance of the returns are constant over time. That is the assumption of stationarity. However, studies have shown that the premium is countercyclical. That is, it is lower during good times and higher during bad times. This violates the implicit assumption of stationarity. So if the chosen time frame is short, the data is more stable, but the statistical reliability is lower. Conversely, if the time frame is too long, the data is less stable, but there is greater statistical reliability. You should select the time frame carefully to avoid such extremes. Another problem with using historical data is that the estimate may be biased upwards due to survivorship bias. As the surviving firms are more likely to be better performing firms, the equity index is likely to be upward biased, so estimates derived from it are also upward biased. The last step is to calculate the mean equity risk premium for the period. This can either be an arithmetic mean, which is simply the sum of returns for the period divided by the number of periods, or a geometric mean, which is the product of returns taken to the n root. Mathematically, the arithmetic mean is always greater or equal to the geometric mean. You have learnt the difference between the two in level 1. In essence, the arithmetic mean is easier to calculate, but is sensitive to extreme values. Geometric mean is less sensitive to outliers as it gives them less weight. The greater concern with arithmetic mean is that it overestimates terminal wealth in multi-period expected returns calculations. For example, if the first year return is 100% and minus 50% in the second, the holding period return is 0% for the 2 years. The geometric mean will correctly reflect this, but the arithmetic mean is 25%. So if we use arithmetic mean estimate returns, we may get higher terminal wealth estimation. And let's move on to forward-looking estimates of the equity risk premium. Such estimates are also known as ex-ante estimates. There are three main categories of forward-looking estimates: those based on the dividend discount model approach, macroeconomic models, and estimates from surveys. The common strength of all these methods is that they do not rely on an assumption of stationarity and are less subject to problems like survivorship bias. Both of these are problems we identified with historical estimates earlier. First, the dividend discount model approach. If you recall from level 1, based on the Gordon growth model, the value of a company is the next year's dividend over the required return of the stock minus the growth rate. Rearranging, we get this expression to determine the return on equity. Aggregating the market as a whole, the expected return on the market is the next year's dividend yield of the market plus the earnings growth rate. Since the market return is the equity risk premium plus the risk-free rate, the equity risk premium is as such. As such, the GGM equity risk premium is estimated using the expected market dividend yield plus the expected earnings growth rate minus the current long-term government bond yield. This is a popular method for estimating the risk premium for developed markets because of the ease of getting reliable forecasts of dividend payments and earnings growth rates. However, one weakness of this approach is that these forward-looking forecasts will change through time and need to be updated. During a typical economic boom, dividend yields are low and growth expectations are high, while the opposite is generally true when the economy is less robust. Also, government bond yields tend to be higher during an economic boom. So, for example, suppose that during an economic boom, dividend yields are 2%, growth expectations are 6%, and long-term bond yields are 5%. The forward-looking risk premium would be 3%. Perhaps during an economic bust, dividend yields are 4%, growth expectations are 3%, and long-term bond yields are 2%. The forward-looking risk premium would be 5%. This is consistent with the notion that investors are fearful during bad times, so they demand a higher risk premium. Another weakness is the assumption of a stable growth rate, which is often not appropriate in rapidly growing economies. Such economies might have 3 or more stages of growth: rapid growth, transition, and mature growth. In this case, another approach under the Gordon growth model is to forecast the future cash flows from all the companies for all the stages and equate their present values to the current equity price index. The discount rate that solves this equation is the IRR, and this is the required return on equity. The forward-looking estimate to the equity risk premium would be the R from this equation minus the corresponding government bond yield. The second approach is to use macroeconomic models, which are also known as supply-side estimates because of the focus on supply-side variables that fuel GDP growth. The equity risk premium is based on the relationships between macroeconomic variables and financial variables. The implicit assumption is that there is a strong relationship between macroeconomic variables and asset prices, which filters down to the price of the equity index. This assumption is only reasonable for developed countries where public equities represent a relatively large share of the economy, so the disadvantage of this model is that it may not produce a reasonable estimate for emerging markets. One common model proposed by Grinnell-Kroner is based on the decomposition of the return on equity. Starting from the fundamentals, the ERP is the return on equity minus the expected risk-free rate. The return on equity can be decomposed into the income component, that is, the dividend yield, and the expected capital gain. The capital gain component can be decomposed into expected repricing due to expected growth in PE ratios of the market and the earnings growth per share. Earnings growth can be expressed as the expected inflation plus the real economic growth plus the change in shares outstanding. As such, the ERP can be modeled as a sum of all these components. The difficulty of the model is for the analyst to determine all these parameters. Dividend yield can be estimated using that of a broad-based market index. The change in PE is the analyst's adjustment for over or undervaluation, where 0 means the analyst expects market to be fairly valued. Expected inflation may be estimated by comparing the US Treasury yield to US TIPS yield of comparable maturities. TIPS are inflation-indexed bonds. The expected real earnings growth rate is the real GDP growth rate, and the expected change in shares outstanding often varies widely across countries for a variety of reasons. It's not likely you'll be asked to make all these estimates in the exam, but if given the figures, you should be able to fit them into the model and calculate the equity risk premium. As a practice, see if you can calculate the equity risk premium based on these hypothetical data from the US economy and market. Pause the video now and work out your answer. And we're back. The only component that requires a little more calculation is the expected inflation, which we estimate using Treasury bond and TIPS yields. We get an answer of 2%. Expected growth in EPS is estimated using the GDP growth rate, which is 2.8%. Expected PE growth for the S&P 500 is given as minus 1%. This means that the analyst feels the market is currently overvalued. The expected income component is the S&P 500 dividend yield, which is 2.3%, and the expected change in number of outstanding shares is given at 0%. And we estimate the expected risk-free rate using the 20-year Treasury bond yield, which is 2.5%. So, plug all these figures into the model, we get a forward-looking equity risk premium of 3.6% for the US market. And the last approach to estimate forward-looking equity risk premium is simply to survey experts about their expectations and use the findings to derive a consensus expectation of the equity risk premium. For example, Global Survey of Finance Professors, Analysts and Managers in 2016 revealed that the average expected premium was around 5% in most developed markets, but was in excess of 13% for countries for some emerging markets. And that concludes this lesson on the equity risk premium and the various approaches to estimate the equity risk premium. This leads us to our next topic, where we use the equity risk premium to estimate the required return on equity.